This incredibly interesting chart ranks the top worst starts to the year in the stock market. So far, we've had the 4th worst start to the year in history. But when you look at the right column, what do you notice? In most years, the stock market actually returned a huge amount after that bad start to the year. Will that happen again this year? This is normally where you could insert something like a crystal ball joke, but by now, you guys know the drill. Obviously, nobody knows the future, except for David here, who's calling for the S&P 500 to hit 6,000 this year, which is about 35% higher than it is today. He really earns that contrarian descriptor in his Twitter bio, eh? Honestly though, I kind of respect a big call like that. I mean, hey, anything could happen. And part of me would be very happy to see my portfolio just go like completely bananas. But on the other hand, over the most recent drop in the markets, you can see here that I've moved a solid chunk of new cash into my investment accounts to make some purchases while we were dropping there. And you can see that I still have a pretty solid good chunk of new cash ready to go. So the other part of me would kind of like some lower prices. I do definitely have some limit orders set up to try and scoop the lows if I can, if we get any more panic selling events. Anyway, instead of going through wild predictions today, I thought it could be kind of fun to basically look at where we're at right now. Look at what factors are exactly influencing the market, and then kind of play out a few different scenarios and see where we might end up. It can be a fun little exercise to do, and you guys can make up your own minds and join in the discussion down below. It kind of feels like we're at this precipice, kind of teetering on the edge of maybe another decline, or on the other hand, it also kind of feels like because everybody is so negative and bearish, maybe that leaves the door open to a big unexpected rally. So the way I see it, which is probably not 100% correct because I am a student of the markets, I am not a master, is there's 2 main factors to pay attention to right now, along with 2 potential wildcards.
You triggered my trap card!
Factor number 1 is inflation. And inflation is right now, well, quite elevated, as I'm sure you're well aware. And it's at risk of becoming entrenched within the economy for a prolonged period of time. Factor number 2 is interest rates. At the March meeting, the Federal Reserve raised interest rates by 25 basis points and guided for a total of 7 rate hikes this year, bringing the Fed's fund rate to just under 2%. Now that might have sounded like a lot of jargon if you're not super familiar with the Federal Reserve and how they manipulate interest rates and all this kind of stuff, but don't worry, you do not have to be an expert in this or really familiar with it at all, because what is happening here is actually a really simple interplay between inflation and interest rates. In a very basic and oversimplified sense, you can think of inflation as the temperature of the economy. This temperature is determined by the balance of money in the economy versus the supply of goods and services. If too much money chases relatively too few goods and services, then the price of those goods and services will rise, and vice versa. For example, we've seen gas prices rise dramatically because a conflict, a geopolitical conflict, has caused the global supply of oil to change relative to the amount of money that is trying to buy oil-related products. So inflation equals temperature. High inflation means hot economy, higher prices. Low or even negative inflation means a cooling economy, stagnating or even lower prices. Ideally, you want a warm economy. Warm enough to sustain life and growth, but not hot enough to raise prices too fast or too cold to sustain any type of growth. Right now, we are hot, but that can potentially be changed. And the way it can be changed is through the use of a thermostat. This is where interest rates come into play. Interest rates in the economy kind of act like a delayed thermostat. If you hike interest rates up, you are basically turning the thermostat of the economy to try and cool it down. The opposite effect can happen if interest rates go down. So there's this important interplay between the temperature of the economy, inflation, and the thermostat, interest rates that can attempt to guide the economy into various scenarios. Now, I know that I have a fairly mixed audience. I have a lot of people who are new beginner investors or people who are just casually interested in this type of stuff, and I also have some advanced investors following along. And if you fall into that camp, then you might be listening to some of this stuff and already be pretty familiar with it. But one thing that you might not be familiar with is this incredibly cool platform that I recently came across called Composer, who are kindly sponsoring today's video. First of all, I have to say this platform is just absolutely beautiful. The branding and design of it is just... So I personally have never seen anything like this before. And basically what it is it's a place where you can build automated trading strategies very easily. This is the type of thing that's normally reserved for hedge funds or quantitative trading strategies, but Composer has made this accessible to you and me. So with Composer, you can either build or select your own symphony, get it? Composer, symphony. To execute these automatic trading strategies. Let's actually look at one here so you can understand better what I'm talking about. So Composer has a whole bunch of these different pre-built strategies that are either built by Composer or they're built by users of the platform. Now, I want to look at this one in particular for this example called Hedge Fundies Excellent Adventure Refined. A great name. So I thought this one in particular was really cool because it's based off of a strategy created by a member of the Boggleheads forum going by the name of Hedge Fundy, but then it's tweaked to smooth out the risk of this strategy. And you can see here that it shows you the performance of all these different strategies back tested in time. And you can see that for this one in particular, going back to 2009, it has absolutely smoked the S&P 500 by a lot. And it's also done it with less risk, having a maximum drawdown of only 32% compared to 50% for the S&P 500 over that same time period. Now that's a huge win, way more reward with less risk. Now the way this strategy works is fully shown right here in the construction of the symphony. And you can see here both a visual representation on the left and then a text explainer on the right of exactly what is going on here. So you can see that every month this strategy would ask, is the S&P 500 10-day max drawdown below 5%? If yes, then it will trigger risk on. If no, it will trigger risk off. And then you can see the different parameters for each of these conditions. So for risk on, the portfolio will hold UPRO and TMF in the balance shown here. For risk off, the portfolio will instead switch to holding a mix of bonds and gold ETFs. And that's how it accomplished such great performance over the past decade plus. So this is definitely one of the most interesting financial tools I have ever come across, and you can check it out for yourself in the description down below, and you can also find important disclosures there as well. As you all know, none of this is investment advice, and past performance does not predict future returns. Thank you to Composer for sponsoring this video. Really cool platform. Like, I can't say it enough, and I can see myself spending way too much time tinkering with this. I just know it. Okay, so going back to our economic scenarios here, we got the temperature of the economy and we got the thermostat. So we've got that. Now let's play with these two things to try and take some fun guesses at what type of different scenarios we could have ahead of us. And let's not forget our wild cards, or should I say trap cards, waiting for us.
You triggered my trap card!
Scenario number one, the Big Titan. So the first scenario I would like to walk through is what happens if the Federal Reserve decides that they want to try and raise interest rates a lot to try and bring inflation down. Remember, raising interest rates means turning the thermostat to a cooling effect to try and slow the economy down and bring inflation down. And if you'd like to learn a new term, this is called tightening of monetary policy. So if you ever hear that in the news talking about, oh, the Fed's tightening, it basically means this. It just basically means that they're trying to cool the economy down. And remember, the economy would theoretically cool down here because raising interest rates essentially acts on this side of the balance. It tries to bring down the amount of money chasing goods and services so that hopefully the other side of the balance, the goods and services, can catch up to the amount of money trying to chase them so it can be a more equal playing field and prices won't rise or fall too much. But if inflation stays as high as it is, then interest rates might have to go up a lot to bring it down. This chart shows the current gap between inflation and interest rates, and you can see that the gap is as big as it's been in decades. Okay, so what if they did do that? What if they did raise interest rates a lot? Oh no.
You triggered my trap card!
Oh no, we've activated the first wild card, a recession. Here's the problem. If you try and cool down an economy too much, then you basically act on this side of the balance too much and basically get to the point where not enough people are spending enough money trying to buy things. On top of that, raising interest rates a lot would likely lead to a yield curve inversion, which has occurred before pretty much every recession going back 60 years. I actually went into much more detail on this, on the yield curve and recessions, in a previous video, so check that one out if you want more information on that and to learn how to prepare yourself for a potential coming recession. So while we might potentially get inflation down by bringing interest rates up a lot, the cost of this would be potentially a recession. What would this mean for markets? Well, almost certainly lower asset values in a recession and possibly even a crash. So for scenario one, the benefit is we finally get inflation under control, but the cost is a recession and possibly a market crash, which, isn't the worst thing in the world if you are a buyer of assets right now, which I personally am. Scenario two, the big pivot. Now, this scenario starts off much like scenario one. The Fed starts raising interest rates to try and cool down the economy. But at some point, they decide to make a big pivot and head in the opposite direction. You see, the Fed is very aware that by raising interest rates, they risk essentially breaking something in the economy and causing problems. Ultimately, they may reach a point where they have to decide, hey, do we keep raising interest rates to try and bring down inflation and ultimately kind of kill the economy like what happened in the 70s? Or do we raise interest rates up to the point just before something breaks and then stop and maybe head in the opposite direction? Unfortunately, either option's kind of painful for us because one option is let's get this over with, let's just get it done with, gets rid of inflation but possibly hurts the economy in the short term. And the other one is a more long, drawn-out, slow pain, because you don't necessarily cause a recession, but you allow inflation to run hot for a prolonged period of time. Oftentimes, it's more palatable, especially politically palatable, for the Fed to use the thermostat to cool the economy just up to the point before it actually causes a recession, because a recession is very obviously bad and people make a big fuss about it. This is what happened in 2018, 2019. The Fed started to try and cool the economy a bit. They started raising interest rates. They raised rates about 4 times in 2018, but the stock market did not like this very much at all, and it began to sell off, going down about 20%. At that point, the Fed did a complete 180. They said, you know what? We're actually going to stop raising interest rates here, and instead, we're going to turn the thermostat in the other direction and actually start trying to heat the economy back up again. The stock market then rallied 43% until, unfortunately, COVID came along and kind of killed the party. So the idea here is that this is potentially what could happen again. The Fed has started raising interest rates, and they've guided that they're going to be raising them a lot more, but if the market shows too much pain, or if something breaks in the economy and they cause a recession, then it's possible that the Fed would then say, oh, we're going to stop here and maybe even consider cutting interest rates again in the future. If this happens, then the same scenario that played out in 2019 could happen again. The market could rise dramatically. Hey, maybe even to 6,000. So that's the benefit of this scenario, but don't forget there is a cost, because the cost to this scenario would potentially mean that inflation stays around and stays elevated for a prolonged period of time. Scenario 3, the soft landing. Now, this scenario is probably the one that the Fed is actually trying to accomplish, but it's also the most difficult to pull off. Essentially, the Fed is trying to land a plane right now, a plane with broken wings in gale force winds.
How the hell you gonna be afraid of heights and you the damn captain?
I ain't never been off the ground before, man. We flew on computer simulator.
Whatever they do, there's probably going to be damage somewhere. But if it turns out that fate is very much on our side, maybe, just maybe, a soft landing can be pulled off. A soft landing means that basically two things would be able to be accomplished. The first is that inflation would come down. The second is that interest rates would be able to rise. But these two things would happen without causing a recession or a market crash or any major negative economic consequences. This would mean very carefully raising interest rates to the point that it doesn't knock that balance of money and goods and services out of whack too much in the economy. And it would also mean a ton of good fortune in the commodity markets. Basically, it would mean a mix of expert maneuvering, a whole lot of good luck to essentially thread the needle and avoid most of the damage. If this happened, the markets could potentially react in a fairly lukewarm way, maybe trading sideways or slightly up, or they could absolutely love it. It's kind of hard to say. That's because interest rates would be higher, which mathematically means that asset valuations should be lower, but inflation would be under control, which removes a major risk overhang from the markets right now. Scenario 4.
You triggered my trap card!
All right, just shut up, Kaiba. It was funny earlier, but let's just give it a rest for now. This is by far the worst outcome, and one that, I obviously wish I didn't have to discuss, and that would be a further escalation of the war. With the atrocity continuing in Ukraine, it means that geopolitical tensions are very high at the moment. While the people of Ukraine are suffering immeasurably, the fallout of these events is spilling out into the entire globe, having large ramifications for commodity markets. They call Ukraine the breadbasket of Europe, after all. This volatile and devastating situation has the potential to evolve in dangerous and unexpected ways, and thus presents a major wildcard risk overhang to the global economy at this point. There's nothing else I can really say about it due to the unpredictable nature of these things, other than that for humanity's sake, I wish it would end, and that justice would be served appropriately. So those are some of the different roads I see ahead of us. Now, all of these different roads I don't think have equal probabilities, and I think a useful exercise is to think about the future as essentially like a probability cloud and then assign probabilities to each of these scenarios and then plan your investments accordingly. For me personally, as my OGs will know, my ETF strategy always stays the same. It's just to continuously dollar cost average into the market no matter what. For individual stocks, I'm pretty happy with my current allocations, but I'm not opposed to buying things at lower prices. So I do have some limit buy orders set to hopefully try and essentially catch one of these wicks that can occur in a panic selling event. And as for crypto, as I've been sharing on Instagram, I basically let Bitcoin kind of tell me what to do. If it trades above this particular range, then I start dollar cost averaging out of my position. If it trades at or below the bottom of this range, then I will start dollar cost averaging back in. And that's primarily Bitcoin and Ethereum, but if we do start heading quite a bit lower, then I'm definitely going to be looking at picking up some alts as well And on top of that, I'm also currently still in my various DeFi farms as well. If you want to know exactly when I'm buying or selling something or what I'm buying, I post a story on Instagram every time I place a trade for anything other than index funds. And with all that said, I hope this was interesting for you. Don't forget to check out Composer before you head out, linked down below. And thank you so much for watching. See you again soon.